Hey traders, Nick here. Thursday, 11/18. Markets are at all-time highs. I think the Nasdaq broke one. The rest are near all-time highs. So it feels bearish. It feels bullish. That's because the mega caps, giga caps, like Apple and Amazon, are up 3 and 4%. So they kind of give you a scoreboard that doesn't reflect the real trades in all the other stocks. So if you look at the heat map, you'll see giant green boxes and the rest is red. It's fine. They call it rotation from one to the other. But it's important to put perspective on the fact that, okay, yes, the bulls are completely in charge, but you have to leave room for potential 1 to 2% dips, which means that if you see I'm making a point to the next point that I'm going to make, which is bullish. I'm looking for a knife to catch. By the way, there are like dozens of them today. I'm going to focus on one, Twilio, but I'm going to frame it that it doesn't trade in a vacuum. So if we get some sort of a tizzy because some Fed head says some crazy thing, then temporary dips will cause dips in the best of knives to catch. So if you think that your stock's falling and it can't fall any further and then the market corrects, guess what? It's going to fall further. That's the point I'm making. So, meaning I don't pile in with a complete position. If I usually buy 100 shares, I should buy 30, 40. If I buy 10 calls, I should buy 4 or 5. Leave room for error. Conviction should be medium at best in these conditions. Why? Because we've never had these conditions before. Even Powell says it like 3 or 4 times in every meeting, basically, that this is all new to us. We're just making it up as we go. All right, on to the message at hand. So somebody asked me in the chat room, by the way, if you do not subscribe to this channel, do it. Hit whatever they say, hit the like button and smash the like button or whatever if you like it, or if you hate it. They don't make a hate button, so they end up putting comments and hating in the comments. But subscribe and set the alert for future videos. It's free so far. All right, so the question came from the chat room and about Twilio. So I comment on charts all day, and this one I think deserves a video. So this stock runs super fast in both directions. It has good fundamentals. It has beaten the bears quite a few, for a long time. So let's look at the income statement. When you have a stock that goes from 88 million to 2.5 billion in revenue, you can tell that it's doing whatever it needs to grow its business. And the net income still loses money, but who cares? Amazon did that for 10 years. So you can't short it unless we have the environment change. It's not cheap. Price to sales is 21. It's not outrageous. That's about Tesla price-ish. About double, almost triple Apple, 5 times the price of Amazon price to sales. So it's not cheap, but it's not exorbitant. It could grow into it as fast as it grows the sales. That's what I'm saying. All right, so what's the opportunity here? It's falling 5%. I don't know. Does it have a headline? I haven't read. Headlines are BS anyway. Points, Twilio shares fall on afternoon trading after several analyst firms cut the price target on the stock. So let's see what their price target is now. Let's see here. Okay, you gotta love Wall Street. They sell the stock because now it's only going to go to 360 from 280 according to this bull crap. So anyway, I don't pay attention to that stuff. So it's falling into support. That's what I pay attention to. Look left and see what levels matter. This guy matters, so I assume it's support until it fails and I stop out. That's how I catch a falling knife. If markets are fine, this will bounce and give you a smashing rally. That's my new word today, smash. It gives you an opportunity at a rally. And here's what I would think would happen. That's Clover, by the way. Side note, 2 days ago, overnight, we had a headline that they issued $300 million, basically diluting their stock. It fell 10% or 8%. Today, they're rehashing the same headline. It fell another 8 or 10%. If this is the case, and that's the same 300 million shares, that's a mistake in the headline thing, so I would buy it. That's side note. It's a speculative stock, so please know that. All right, so here is the opportunity. The assumption, again, the thesis, I already told you the macro, my thought, what the world looks like. We could trip a little bit, and it could fail this one. through no fault of its own. Therefore, I don't take big positions with conviction. My assumption is that this will hold, this zone. This candle gives you quite a bit of information. They opened here, they hated it, they loved it, they came back and they closed exactly where they opened. If I look left, that was an important. I had so much caffeine today, I'm like not very accurate with the lines, sorry. And this is where we're at. So this should hold. If not, this should hold. So even if it does this, I think it does that. And then here is the opportunity. It's resistance, of course, and it'll fail here, probably get back up here, and then try to fill the gap. This is bigger resistance up here, so it's going to be a slog. Step 1, hold support. If it goes below support, I'm out. My thesis is broken. This is a trade, not an investment, so my thesis is broken. That's the difference. So that's an actionable set of lines. Let me walk you through it. I looked at the candle. I saw a range. We're at the middle of the range where they were indecisive, and they were months ago. So it's a significant zone for buyers and sellers. Below it, I have a hard line that would get me out because, hey, support failed. Well, maybe you would make it this one. I don't know. I mean, they're so close together. I don't think this will give you the opportunity. If it loses it, it probably goes whoosh, just like it will go like this without giving you a blink. And then this zone and this line are resistance, but they are also triggers eventually if they can overcome them. So that would be the trade. How would I do it? I would take a long, however I take longs, and stop out down here. So if I buy shares, I will get out of the shares. If I buy calls, I would get out of the calls. If I sold a put or a put spread, I would do the same. So how would I like to go long stocks? If I have super strong conviction, I would sell a put to buy a call. That is the most aggressive way. In this day and age, I would do one or the other if I'm aggressive, because I'm a medium at best, right? Conviction. So I would eliminate one of those two. I either buy the calls with a tight stop or sell the puts with a tight stop. If I don't know what selling the put means, please do homework. It is dangerous stuff if you don't know what to do. You have to be able to own shares. Otherwise, I would never sell a put. And I'm not recommending a trade here. I'm telling you how I would act on this one. Somebody asked me, what do you think of this chart? And I'm saying that my assumption would be as it holds support. And if it was me, I would take a long here into that support and stop out. Okay. How I would do it is I personally could sell a put because I want to own shares, or sell a put spread, milder version of it. I could buy a call, very aggressive because they're expensive, or buy a call spread. Okay. So that's how I would structure a trade. But the most important part is, one, I define what my reason is, and it's this support. So therefore, two, I define what would get me out, which is losing my reason. That's the second part. And then where I would get out booking profits. This would be a good exit point, leaving some runners. This would be a good starting exiting point if I catch a bounce. So depends on what kind of trade I did. All right, so the advantage of buying naked calls is that it pays really quickly, but the pain would be pretty quick too. So if you've never seen what an options chain look like, what are we talking about? Twilio? This is what it would look like. This is an E-Trade practice account. I'm not recommending this company, so do your own research on what suits you. So when I say it's expensive to do naked calls, so it'll cost $1,000 to buy one call for December, 29 days. That is a lot of conviction. So if I buy it, it's going to cost me $1,000 per contract. So how can I mitigate that risk? I'll buy a call spread. So if you've never done options, buying a call all by itself will cost me $1,000. If I do a spread, I'm adding something else that I want to sell to make a spread and spread my risk. How is it spreading my risk? Now my cost is down to $300 from $1,000. I limit my upside. But what's wrong with more than tripling my money here? Because if I'm right and it rallies through to 310, this turns into $1,000 per contract. So I invest $320, $300 now to buy the spread, and if it rallies through both and time passes, this 300 will grow into 1,000 per contract. So if I wanted to pay less, I would go higher. I wouldn't, because I want to guess up, and I don't want to have to guess how much up. I want to guess up, and if it happens, I want to get paid right away. So this is December's, which has about 30 days, 29 days left on the clock. They get cheaper. There are cheaper opportunities, not this particular spread, if I take them shorter time. So the $1,000 will get cheaper if I use next week's. It's 700, but boy. So somebody that did this yesterday bought a naked call, this one. They lost half their money, more than half their money today. So that's why I'm telling you, one bad day can ruin this trade. Why? The debit call spread makes better sense because the out-of-pocket pain is not as much on bad days. Why? Because if they had bought a call spread yesterday like this one would have lost 50%, but this one would have offset that losses because they sold it and now it's cheaper. So it helps the wound. It eases the pain. So the out-of-pocket pain is not as much, and therefore they are not stopped out immediately if they want to stay in the trade with conviction. So these guys or girls would have made a lot of money faster than this person, but look, they lost half their money overnight. Not a great thing to do. But these people made 200% on their money if they guessed down for some reason. So the best way is to have a thesis and try to make it work. And the one way to make it work is to know how to manage it. And if I know from the get-go that if the price falls below X, I'm out, then I'm confident that, okay, my damage, unless it opens down 10-15%, then there's nothing you can do. You don't have the chance to exit. So, but hey, if there's no risk, there's no reward. All right. So do your own homework. Those are my thoughts answering a question to somebody in my chat room.